Hello everyone, welcome to Accounting 312. In this video, I think it's the last video of this chapter for the chapter material. We will talk about chapter 23 very quickly, briefly. I would say I'm not even making the handout. I have an old version, but I think I just go with textbook. So let's look at go to chapter 23. No matter you use your e-textbook or use your hard copy. Chapter 23, I personally actually like this chapter. So it's talking about the performance measures. What does this mean? Everybody, as the manager, CEO, you want to evaluate the employees' performance, right? Whether they're doing better, they're doing good, or whatever. So how do we evaluate them? That's it. It's think about the situation like you are the student, you will be evaluated. I'm professor, I will be evaluated. Actually, as a professor, I'm always trying to say what's the best way to evaluate students, how to be fair and then how to be consistent, kind of like that. So you want to get the measure that can reflect the true performance, right? Reflect the true performance. So first thing, I'll just go through the textbook. You can just read briefly. First thing, we talk about financial and non-financial performance measures. That goes to our chapter 12, balanced scorecard. The main point here is when you evaluate your managers, even me, when I evaluate students, we should not just focus on financial factors. We also need to think about the non-financial factors. Yeah, some managers, they may give you more profit, but they are very rude to the customer. They never train the employee. So you cannot just focus on one measure. You have to think about the overall balanced scorecard. For me, I would say some students even didn't really get 99 or 100, or just got overall B, but they help other classmates, they participate in class discussion. I really appreciate that. I want to say thank you, since we're talking about that. Thank you for the good semester. I really enjoy the semester. But let's continue with our chapter. Right? I don't want to be too emotional. Second part, talking about really if we just do numbers, so what measures should we use? So they talk about 4 measures, I believe. They give you an example, said, hey, you are the CEO, you have kind of 3 locations, San Francisco, Chicago, New Orleans, and then talk about which one is the best. So if you just look at the income, you will say, hey, New Orleans seems it's the best, 510,000 versus 300,000 versus 240,000. That's not right, because you cannot compare apple with orange, right? New Orleans, this is the highest operating income. Yeah, maybe because it's good, but also maybe because it's just larger than other 2 hotels, right? So you cannot just look at the absolute operating income. You have to scale this number based on the same base, so they can compare apple with apple. Don't worry, I'll just go through very quickly. I don't worry about my students because you have a computer, you have internet, you can always Google, hey, how do you get ROI, return on? So I'm not going to force you. I'm not going to even test you this part. I will tell you which part I will test you. The first measure, we call it a return on investment. This is ROI. I'm not sure whether you have heard this, yes or no. But when you say something on something, so A on B, then the formula most likely is A divided by B, right? So this is your return, which is income, divided by investment. In our chapter, we use total assets as the proxy for the investment. So you cannot just look at the income. You have to divide by the scale, right, by the investment. As I say, I'm not going to test you, so I'm not going to go to detail. So for this San Francisco, Chicago, New Orleans, you have to use their operating income divided by their total assets. So you find out that, oh, seems although San Francisco, the absolute operating income is low, but the percentage actually is the highest one because they just used 1 million, they generated 240,000. New Orleans used 3 million, only generated 510,000. So the ROI is just 17%. Okay, so that's the first measure. As I say, you got the idea, that's it. Second measure, I want to spend a little bit of time on this one because I will test you. Okay, hear me. I will test you. What's this called? It's called residual income. Residual income. That's weird, right? Income is income. Why you have a residual income? We call it RI. What's the meaning of a residual income? I ask you a question. Let me ask you a question. How to say that? Okay. Let me ask you a question, right? Think about this situation. You borrowed 100,000 from a bank. Okay, you borrowed 100,000 from a bank. Bank doesn't give you money for free, right? Most likely, bank will say, "Oh, they charge 10% as interest. They charge 10% as interest." Okay, so this is the required rate of return (RRR). You should know this one from chapter 21. So you borrowed 100,000 from bank. Interest is 10%. So you invested this 100,000 on a project, no matter what project, and then at the end of the year, you got operating income as 120,000. Okay, good deal, right? You got very good performance. Operating income is 120,000. Let me ask you a question. Does this 120,000 belong to you 100%? You say, hey, what's the meaning, right? Like, is this your real income? Is this the real income that belongs to you? Well, I said, not sure. What's the meaning? My purpose, my intention is, once you get this 120,000, what's your first thing you need to do? Hey, look at here. You owe 10% of the interest, right, to the bank, right? You owe the 10% of the interest to the bank. You got 120,000. The first thing you need to do is you need to return 100,000 times 10% as interest to bank. You have to first pay this 10,000 interest, right? So not all of the 120,000 belongs to you because 10,000 is the first thing you need to pay your debt holder. Bank is waiting for you. So your actual income, the income that is left for you, which is the residual, that's why we call it the residual income. That's why we call it the residual income. It's the money after you paying the required rate of return, after you paying the rate on the investment. That's your leftover, that's your residual. So it will be your operating income minus your return time the investment, right? Time the investment. In our situation, your residual is just 10% time 100,000. So your actual, the real money belongs to you is just 110,000. That's it. That's the residual income. Residual income, you use your income, but you need to first pay the required return, right, to your bondholder, to your stockholder. So the actual income belongs to you is called residual income. You will be tested. You will be tested, and I put some practice for you to get better idea on this one. Residual income is the your income minus dollar amount for required rate of return for the investment. So the formula will be residual income equals to your income minus required rate of return times the investment. You say, I want to look at some example. So remember, they have the absolute income. Question will tell you the required return is 12%, and we said the investment is your total assets. So not all of the 200,000 belong to San Francisco, not all the 300,000 belongs to Chicago, not all the 510 belongs to New Orleans. They have to pay their return first. So they subtract the return That will be their residual. That will be their residual. So we said residual definitely higher means better, you know. This is the residual income. This is the residual income. Okay, I stop here. I don't want to have a long video because next time we talk about the EVA. This is important. I want to spend 5 to 10 minutes on this one in a separate video. So I see you next time.